Hello everyone, welcome to Equity Sciences. Today is just a brief review of our Allocation Sciences line of allocation models. And much like our quantitative solutions, our Allocation Sciences line can either be a purchase product in which clients can deploy plug and play. You can deploy the variant that we deliver to you, and or you have access to the inputs and codes, so you have the ability to customize, backtest, optimize, etc. for those who want to be more involved. For those who maybe not have much time during the day, we also carry these as a signal service in which we deliver the signal to you via email structure. And let's see, here is the the basic structure of how it will receive via email. SPY yesterday 8%, today 15%, action buy 7%. So extremely easy to follow, right? And this is just a general example. We're always trying to improve how we deliver these via email structure. So some of this may change. We may update that along the way, but ultimately with every product or service, we intend to allow clients to leverage years of research to deploy adaptive, intelligent, quantitative solutions, but in a quick, simple, direct manner, right? And so it's very critical for us to be able to deliver, no matter how complex the concepts or strategies, etc., may be, that clients of all experience levels can deploy them in a quick, simple, easy to follow manner. And so this is the basic structure, and then this is where they're located on our website, which is equitysciences.com. And again, they are offered as a signal service and or a purchase product. And the difference between our allocation models and our quantitative strategies is the main difference is that our allocation models really don't deploy logic that identifies optimal entry and exit prices. Right now, we do obviously deploy some exit models and some very basic entry models, but the main focus is to show the I guess the importance of an intelligent adaptive allocation model, and that when it's just deployed on its own, when compared especially versus buy and hold, and when allowing multiple entries per position, it can nurture positive outcomes. And so this can be deployed as a semi or fully automated strategy. It can be deployed as a discretionary strategy, obviously, and or within your discretionary analytics, confirmation processes, and or used as your allocation or money risk management methods within, no matter if it's a discretionary swing, intraday, etc. strategy. So a lot of versatility within the product, no matter if it's a purchase product and or a signal service. And so we broke it down into two main packages: our allocation signal service. All ETFs are included in that package, and all equities are included in that package. So for just $97 a month, it's a pretty significant value that we're offering our clients. Basically it's 20 strategies or 35 strategies, etc., and in just one package. So conceptually, everything begins and ends with us again with diversifying the factors that produce outcome. And so we kind of structure everything around market classification. This is a basic visualization of market classification, to kind of show how difficult it would be for the human to kind of capture or identify certain market environments or conditions. So these are some basic moving averages, and these three are indications based upon that. So where close price is relative to the moving average. We have a 20, a 50, and a 200. This is a volatility indicator, and this is directional movement. You have positive and you have negative. Because negative movement occurs at a slightly faster rate, so we can typically monitor that at a smaller look back than we do, because we want we don't want much lag there. So we do analyze those at multiple frequencies, but we typically don't really necessarily deploy these analytics. It's just a general kind of visualization, I guess you could say, of And so the general framework for an allocation model is we have a multi-factorial value calculation, right? This is just a general example again. So we're looking at where close is, how deep price movement has gone, both on a kind of a long-term cyclical and short-term or intraday basis, and then we translate that into a percentage. And then we use classification to further exploit specificity, and use that as a multiple. So that really determines the N shares value, right, based on the classification, and then also what this calculation is outputting here, right? And so here we pretty much have two different allocation model entry types. Both of them are pretty simple and basic. One of them has a slightly different, I guess you could say, a little more selectivity, within the entry structure, and so basically the logic's very simple. It's close less than open or low less than low 1 bar ago, and then it's buy. So if these two criteria is met, then basically it's buying, and that's the reason why you see a lot of trade frequency on these setups. And so and the real focus is really trying to determine this optimal value here, right, based on the current market environment and substructure, and where we are from a multi-factorial value perspective, right? So this is the main focus of an allocation model, right? We're not really trying to find a specific target price, whether that's close minus some dynamic calculation or pivot low minus some calculation. So, and then the second, which is a little bit more selective, is the same basic logic as the first. However, then we're saying, okay, further we'll use a little bit more classification, and say, okay, if classification equals 1, and then we'll have another calculation that's kind of similar to this but slightly different, and we'll say, okay, when this value is when this percentage is greater than a certain percentage, right, then it'll allow to buy, right? So this calculation is still the same, right, but we have I guess you could say a conditional statement here, right? So we're looking for some type of relative value before the initial entry will occur based on the current classification, right? So it's a little bit more selective, still very, very simple. And so here's our basic exit logic that we apply. You have a positional basic exit, if close greater than average entry price plus value, and then you have per entry tracking exit, which is a scale out exit, right? So it's a per entry, and you can scale in or scale out, or you can scale in and all out, right? And so those are the basic calculations. Now let's see. So market classification is basically this. So we'll look at multiple frequencies of analytics, multiple types of analytics, right? And then we'll just determine classification. We'll break it down into 64 different environments and substructures, and then that helps us to identify what optimal values are based on a repetitive classification. So at any point given in time, the market will always fall within one of these 64 classifications, and we have we intentionally design and use analytics that allows us to identify we look at volatility extremely closely. We also look at overbought, oversold conditions pretty closely, and so we want to be kind of specific in those areas. So it really gives us the ability, using 64 environments, to really be specific. And so I want to show the versatility of the product. And so here is the same allocation model applied to the same asset, but in 4 different ways, right? As you can see, this one has longer position holds, right? All of them, obviously, all of our concepts allow multiple entries. It allows us to exploit multiple types of value, intra condition and intra position. And so we found in our research that allowing multiple entries really helps nurture more positive overall consistency. And so, but as you can see here, you have longer term position holds, more shorter term position holds. Here you have I attached an additional per entry profit target, right? So you can get really creative with it if you choose to, or you can plug and play. You can deploy the variant we deliver to you should you choose to purchase it. Or you can, have the functionality to deploy it and customize it, optimize it, backtest it, etc. as you wish. So here again, before I get into some results, let's review the disclaimer. Historical performance, whether live or simulated, may not be indicative of future results. Trading equities, futures, or FX carries a high degree of risk that may not be suitable for every investor. Investors should only choose to invest funds they can afford to lose without negatively impacting lifestyle. We do not guarantee nor claim our products will perform positively and/or reflect their historical results. In fact, there can be significant differences between historical and future results. Please consult your investment professional before selecting any trading or investing product to ensure it meets your investment objectives and risk tolerances. All results and data displayed are historically simulated, not live real. Everything reviewed and discussed is my personal opinion, not to be considered investment advice nor a solicitation of any individual product, service, and/or equity. Okay, and so I just wanted to kind of show some basic simulated simulated examples of this, applied to, again, the same asset, 4 different ways, just so for those who choose to purchase the product and not deploy it as a signal service, kind of see the the versatility that the product will offer you once you purchase it and we deliver it to you. And so and again, these are just some basic simulated examples. And so the product really gives you the ability to really customize, to vary to more specific, preferences, objectives, etc. And so maybe you want longer term positions holds, higher return, higher growth, higher risk, higher return profile, or maybe you want, a shorter term position holds, maybe less risk profile, more consistency. So maybe you would go with an option, something like that. But here again is the same model applied to SPY. Another simulated example. And again, this is the same model. This is actually not the selective version either. And here we go, some more historically simulated results applied to XLP, RSP, IWM, and AT&T as well. So there's RSP. There's XLP. IWM. And AT&T. And surprisingly, we found that a lot of quantitative researchers and strategists place a very significant amount of time, effort, and resources into sourcing alpha, right? And obviously, being efficient from an entry perspective is important, but we felt and found in our research that an intelligent adaptive allocation model, its potential impact is far greater than I feel that is, I guess you could say, adopted or deployed within within the industry. And so from both improving overall outcome consistency, your return potential or profitability potential, growth potential, and risk mitigation. Whenever you're combining multiple entries, value type of calculations, so maybe allocations are increasing as value increases, right? And so whenever you combine those and you apply it to markets that index sector ETFs and large cap blue chip stocks that are fundamentally and behaviorally justified, that their linear bias is fundamentally supported or justified. And so surprisingly, whenever you apply an intelligent allocation model, even without determining optimal entry prices or targets, etc., logic, conditions, etc., it can still produce a pretty consistent result, when customized. And so, again, our products, can be deployed, as a purchase product in which you have access to everything and/or a signal service. And so this is, where the products can be purchased or leased, on equitysciences.com. Again, it's to our benefit that our clients are successful with our products or service, no matter if it's, a purchase product, and obviously we help with the setup and familiarization of that. And we maintain an open door policy, no matter if it's a purchase product, a signal service. So if you have any questions regarding our products, services, concepts, and/or our customization services, in which we can customize any one of our models, concepts applied to different assets, equities, etc. Maybe you have specific preferences in mind, and so feel free to give us a call or to reach out via email, and we'll be happy to chat with you. Again, appreciate your time, and welcome to Equity Sciences. Good day.